All right, let's jump right in. Picture this, an economy in such free fall that the cash in your pocket is worth less every single hour. I mean, how could a company even begin to figure out if it's making money or losing money? Well, today, we're unpacking the incredibly clever accounting standard built for that exact kind of chaos, IAS 29.
I mean, really think about this for a second. Let's say you sell a car in January for $1,000,000. Then, in December, you sell the exact same car for 100 million pesos. Did you actually make more profit? Or is the money just, well, practically worthless? That's the core problem hyperinflation throws at you, and it makes a normal financial report totally meaningless.
So here's our game plan for today. First, we're going to dig into what it feels like when money just stops making sense. Then we'll introduce the accounting rule that comes to the rescue. We'll walk through exactly how it works, see the incredible insights it gives us, and finally, look at what happens when the economic storm finally passes.
Okay, first things first, let's set the scene. We're not talking about your everyday run-of-the-mill inflation here. No, this is a total breakdown of a currency's value. It's like trying to build a house during a constant earthquake. The very ground beneath your feet is shifting.
You know, what's really fascinating is that IAS 29 doesn't just slap a number on it and say, okay, now it's hyperinflation. Instead, it looks for behaviors. It asks, are people scrambling to trade their local cash for US dollars or gold? The second they get paid, are they spending it immediately before it loses value? Are you hearing prices for, say, a cup of coffee quoted in a foreign currency? When you start seeing all of this happening, that's when you know you're in the thick of it.
And this quote, straight from the standard itself, just hits the nail on the head. It flat out says that regular accounting is not useful. Think about it. Trying to compare sales from January to sales from December is like trying to add 1 inch and 1 mile and saying the answer is 2. The units are completely different, and the result is just gibberish.
So, faced with this financial chaos, what's the solution? Well, accountants have a specialized tool in their kit, a genuine rescue plan, called International Accounting Standard 29. This is what brings order back to the numbers.
And this isn't some newfangled idea they just cooked up. This standard has been around since 1989. It's been battle-tested in economic crises all over the globe, and it's constantly being tweaked and refined, even as recently as 2024. That just shows you how important and relevant it still is.
So what's the magic behind it? The core principle is actually beautifully simple. It's all about making sure every single number is stated in terms of the money's value right now, at the end of the reporting period. It's like if you had a bunch of old maps with distances measured in feet, cubits, and leagues. It's a mess, right? You'd convert everything to meters to actually understand it. IAS 29 does the exact same thing, but for money.
Okay, so we get the why. We need a common measuring stick. But what about the how? How do accountants actually do this? Let's open up the rulebook and take a look.
The absolute key to this whole process is a tool called the General Price Index, or GPI. Just think of it as the official inflation calculator for the entire country. It gives you a single, reliable measure of how much the currency's purchasing power has changed over time. This is the Rosetta Stone that lets us translate old historical values into today's values. All right, now we get to the single most critical rule of the game. IAS 29 forces you to split your balance sheet into 2 buckets. First, you've got monetary items. That's stuff like cash or accounts receivable, money you're owed. These do not get restated. Why? Because a dollar is a dollar. It's already stated in today's value. But then you have the second bucket, non-monetary items. This is your property, your equipment, your inventory. These must be restated because the price you paid for them 10 years ago is a completely meaningless number today.
The actual process, when you lay it out, is pretty straightforward. You grab one of those non-monetary items, like a building. You look up how much you paid for it and when you bought it. Then you use that general price index to see exactly how much inflation has eaten away at the currency since that date. You apply that conversion factor and boom, you have a new restated value that makes sense in today's money.
So we've gone through all this trouble, we've restated our buildings, our inventory, the whole shebang. What was the point? Well, this is where we get the big payoff. This is where we uncover the true, hidden impact of hyperinflation on the business. All that work boils down to one single, powerful number that gets its very own line on the income statement. It's called the gain or loss on net monetary position. This is something you will never see in a normal set of financial statements. It exists only because of this process.
And what this number tells you is absolutely fascinating. It tells you whether you won or lost the inflation game. Here's how.
If you were holding a ton of cash and not much debt, you lost, big time, because your cash became worthless. That's a loss. But, and here's the wild part, if you were holding a lot of debt, you actually gained purchasing power. Why? Because you get to pay back those old loans with new, ridiculously devalued money. It's an incredible insight.
Now, these intense economic storms don't last forever. Eventually, things stabilize. So what happens then? Do you have to keep using these special accounting rules forever?
The answer is actually really clean and simple. You just stop. As soon as the economy is no longer considered hyperinflationary, the company turns off IAS 29. And those final, restated numbers, they become the new official historical costs for everything. It's like you've hit a giant reset button, creating a fresh, stable foundation to go back to normal accounting.
When you step back and look at all of this, it shows that accounting isn't just a set of stiff, backward-looking rules. It's a living, breathing system that can bend and adapt to reflect reality, even under the most extreme pressure. It really makes you think, doesn't it? If we can do this for hyperinflation, what other complex economic realities of our time should accounting evolve to capture next?